All right, hello everyone. It's 2 o'clock. I want to thank everyone for coming today. This is the AgriCharts Grain Professional webinar on why soybeans may be heading lower and what we're doing about it here at Daniels Ag Services. My name's Craig Turner and Drew Wilkins is joining us today. First, we got to give you a few risk disclosures for the NFA. This material is conveyed as a solicitation for entering into derivatives transactions. This material has been prepared by a Daniels Ag Services broker who provides research, market commentary, and trade recommendations as part of his or her solicitation for accounts and solicitation for trades. Daniels Ag Services, its principals, brokers, and employees may trade in derivatives and their own accounts and for the accounts of others. Due to various factors such as risk tolerance, margin requirements, trading objectives, short-term versus long-term strategies, technical and fundamental market analysis, and other factors, such trading may result in the initiation or liquidation of positions that are different or contrary from the opinions or recommendations found contained therein. Past performance is not necessarily indicative of future performance, and the risk of loss in trading futures contracts or commodity options can be substantial, and therefore investors should understand the risks involved in taking leverage positions and must assume responsibility for the risks associated with such investments and for their results. You should carefully consider whether such trading is suitable for you in light of your circumstances and financial resources. You should read the risk disclosure available at danielsagservices.com. Daniels Ag Services is not affiliated with, nor does it endorse any trading system, newsletter, or similar service. Daniels Ag Services does not guarantee or verify any performance claims made by such services or systems. Alrighty, so now we're through with that. Once again, I'm Craig Turner. I'm a Senior Ag Marketing Consultant with Daniels Ag Services. I'm also a contributing editor to the Grain Analyst website and newsletter. I also wrote my own newsletter called Turner's Take. And joining me today is Drew Wilkins.
All right. Hey, thanks, Craig. As Craig said, my name is Drew Wilkins. I am also a Senior Ag Market Consultant with Daniels Ag Services and a contributing editor to Grain Analyst. I also am the author of the Wilkins Ag Wire video. It's actually a daily video service that I put out every morning. So without further ado, let's jump into the presentation here. All right, the first thing we're going to take a look at here is old crop demand. And as of right now, it's supportive. The June 1 stocks report that was released on June 28th showed June 1 stocks to be 435 million bushels. And as you can see, there's no way to explain it other than that being incredibly tight. This implies an ending stocks of 118 million bushels, or 3.82 stocks to usage. So if you take a look at that chart right there, take a look at 2012, which is the second from the right bar, right where Craig has the mouse there. And if you look over, really the previous times we were lower than we are now would be 2002 and 1996. So it's very rare for us to be around the levels that we are right now. So old crop demand is supportive right now for prices just due to stocks being as tight as they are. So with that said, let's take a look and see what we can do to replenish those stocks by taking a look at 2013 planted acres. So along with the stocks report on the 28th of June, we also got what the USDA thought we were going to have for planted acres. They saw planted acres as coming in at 77.7 million acres. Now they actually increased it by 700 million bushels from what they put out in March. So with what we typically have, that would equate to 76.2 million harvested acres. You times that by what they're expecting for yield, which is 44.5 bushels per acre, and that leaves you a 3.39 billion bushel production. So as you can see here, take a look at planted acres. 4 out of the last 5 years, we're kind of right in the same area, around the 77 million planted acres mark. So we're not too far. Obviously, that differs from 2011. But for this year, we're kind of in line with the planted acres. So with that said, let's jump into crop progress here. Crop progress as of late has been bullish. So we got crop progress July 8th, which is this past Monday. 95% of soybeans have emerged. Well, that leaves 4 million acres out there that are not emerged. 3 million of those acres are double crop wheat, which is soft red winter wheat. The rains have really started to slow that harvest. So they're not making near as much progress with the soft red winter wheat harvest as they normally do. As a matter of fact, they're only 57% complete compared to 78% complete last year. The 5-year average on that is 64% as well. So we're well behind the average. So for those of you that aren't aware of what double crop means, as soon as soft red winter wheat is harvested, farmer will go right back in and plant soybeans over where that wheat ground was. So obviously delays in harvest mean later setting pods, things like that. And when you do that later in the summer when it's hotter, you typically don't get as good of a crop, and that's why it's a problem. And this late planting will probably, due to the late planting, we'll probably have 2 million of 3 million double crop acres lost. In addition to that, due to such a wet spring and delays in getting plantings, we're also going to lose around 1 million acres from Iowa, Minnesota, Wisconsin, and North Dakota. It's due to planting delays, wet spring, so just either choosing not to plant, planting something else, or just taking prevent plant. But that same spring wet weather will also allow for 1 million acres that was originally going to be corn. Those were planted in beans. So all in all, we believe that that means we'll have a net loss in 2 million acres planted. So due to that, and then of course getting soybeans in later than normal, late emergence, we believe that the yield will likely be closer to 42 than 44 or the 44.5 that the USDA is looking for. So that takes us from 76.2 million acres harvested to 75.7 million acres, and the yield 42. That leaves us with 3.179 billion bushels in production for 2013-2014. So that's taken away over 300 million bushels. If you want to put that into comparison, take a look at where we are with the June 1 stocks at 435, take away 300, that puts you at 35. So obviously last year was a little different due to the drought that we were in. We're not having drought conditions like that as of yet, but 300 million bushels is a lot, but still a total production of 3.179 billion bushels is pretty decent, and we'll turn it over to Craig now, and as he goes through his part of the presentation, you'll see how that 3.179 billion bushels translates into pricing and production and ending stocks. So without further ado, take her away, Craig.
All right, thanks, Drew. And a lot of Drew was talking about with the crop progress is, we've seen, with the bullish prices in soybeans. We're up about 50 or 60 cents here over the past few days in the new crop. This is it's due to the weather. The forecast changing over the 2-week period, more hotter and drier, and also the concern of losing some acres. So that we've seen definitely that take away maybe on the supply side numbers. And when we're talking about the supply side numbers, we're talking about what we're, with the supply and demand tables that the USDA puts out for every WASDE. Now to counter that, on the supply side, it's not just a supply story with beans right now. There's also a demand side of the story, and we're going to get into that, now a little bit and talk more about the demand. How is demand going to get affected? Because we already know supply is definitely going to most likely come down. So for global ending stocks, they are on the rise, and global ending stocks are going to swell to about 73 to 74 million metric tons. And to put that into bushels, that's about 2.7 billion bushels. So global ending stocks for this year are going to be up 20%. And I think this chart shows it well. This is us here in last year. This is us this year with our ending stocks a little bit higher. And you can see next year, and this is going to include what we just harvested in South America and what we're expected to harvest in the United States. So we're tight right now with the alt crop. We're expecting to have a good, a decent to good crop this United States. And overall in the world, we should have a very good ending stock record. As far as Brazil ending stocks, they're going to be up 33%. And the significance of this is you're going to start hearing in the news, I think, a lot about the long export tail of South America. And when you hear that in the news, you hear that kind of catchphrase, what you should know is that there's expectations because Brazil has so many beans in Argentina, and they got such a late start with the bottlenecks and what's going on in the ports, so they're going to be exporting a lot of beans at the tail end of their export season, and it's going to run into the United States export season. So if they're going to have ending stocks up 33%, one thing to consider is Brazil can't crush much more than they already have without building more capacity. And same with the storage. They would have to build storage to really store this increase in beans. They're pretty much at capacity. So to expect a 230 million bushel increase, are they going to stay in Brazil? Is it going to be crushed? Or is it going to find its way in the export market? And we think it's going to find its way on the export market. So as Drew was saying before, we're losing some supply and on the new crop side, and that's definitely what the market's been trading over the past few years. It's not really time for the market to consider what's going on the demand side, but after we get through this weather rally, I think the market will start thinking more about demand, and they're going to start asking more questions like this. What's going to happen with all the extra bushels Brazil has? Another thing they'll be considering is if Brazil has more bushels than they need, Argentina has more bushels than they need, the United States has more bushels than they need, it can go to exports or it can be used for crush, which will eventually be feed and oil. And the soybean crush is inelastic. We've seen that over the past few years. You can see these lines. Yeah, they move a little bit with how tight we are in the world, but the crush is the crush. It doesn't move that much when supplies, and we can see that now. Soybeans wouldn't be going through the roof, like it did over the summer at $20. We almost hit $20 if soybean, if the crush wasn't inelastic. I mean, they need it. There's not a whole lot of substitute for it. But on the flip side, if there's too much supply, you don't see it like corn where, because corn can be substituted for wheat, if corn's really cheap compared to wheat, then you'll see more corn buying. You don't see the same thing for the soybeans. As far as exports go and more about supporting evidence of where we think this long South American tail is with the increased production this year and with the increased global stocks, U.S. and Brazil, we're going to see a 10% increase in the exports. But Argentina is really the big story. They're projected to basically up their exports by 50% this year. And that would also happen in the tail end. Argentina's been holding on to a lot of their beans just because they've been having some geopolitical risk over there with their government. They've been seeing high inflation. They don't want to sell it until they have to because they think the commodity is worth more in their bins than the depreciating currency, which kind of makes sense. So we're expecting more of a backloaded export with Argentina towards the end of the year. Now, so we're going to see more exports. Another thing to pay attention to, or more competition from foreign countries, is what's going to go on with the Chinese import demand, because really China can kind of save U.S. prices, or it can hurt it, based on how much they're importing. So last year they imported 59 million metric tons. The USDA, as of June, the June WASDE was projecting 69 million metric tons, and they haven't changed that for a while. But considering what's going on in the banking sector in China, the bird flu, what happened with the hog disease they had there, and just generally slowing down, a lot of the private forecasters have come out in the past month or so and really said, we're closer to 66 million metric tons. So what does that really mean? Well, if you know how to convert metric tons to bushels, the rate is usually, one metric ton to about 36 bushels. So we're talking about 300 million bushels here of less demand than we thought. So what does that really mean for us? Well, of everything China will be importing, the United States pretty much accounts for a third of that, and then 2/3 go somewhere else. So if they're going to not have 300 million bushels that we thought there was going to be for demand, the United States will most likely use 100 million from their balance sheet. So let's take a look about where we think demand is going to be for this next year. First, we're going to take a look at what the USDA has. They're calling for 1.45 billion bushels, or 1,450 million bushels on the demand in the balance sheets right now. But we think we're not going to export as much because we're going to lose about 200 to that long export tail in South America that we talked about, and we'll probably lose 100, unless things pick up in China. They aren't as strong as they were, and the forecasts are coming down on their demand. So where does that leave us? That leaves us on the total 2013 exports of 1150. So we have to take 300 away from from where we thought we were. Now, Drew said earlier that we're probably losing 300 from the supply side anyways with the lost acres and maybe the decrease in yield. So maybe one of the reasons why we haven't seen November soybeans actually go up, $1 or $1.50 is maybe the trade is recognizing this. So let's take a look. I also want everyone to take a look at, what it looks like if we just have supply loss, what it looks like if we just have demand loss, and when we combine it all together, where do you think we'll be at the end of the year? So right now we're in a weather market. That's a supply market. And what we're having here is what we did is we took, the acres and we say, okay, we are going to lose acres because of the double crop and what we lost in the north. We did gain some back in, from corn going to beans, but we're definitely going to lose some acres most likely. And so if we lose 2 million, then we're at 75.7, and we usually harvest about a million less. And let's say the yield's 42. I know the USDA is 44.5, but with the late planting, with the weather, there's more talk that 42 might be a better conservative number. And if we do that and we use the same demand numbers that pretty much the USDA has, you can see how tight we are. We could be at 13 or 14 beans. If we do get this low on the total supply, I'm sure the crush and the export probably come down a little bit, so maybe ending stocks will be close to 150 or 160. But now we're still talking about $13, $14 soybeans if we lose the supply and none of the demand comes off. Alrighty, so that's the supply side, and that's what I think the market's trading right now. Then there's the demand side of the equation. Let's say, supply stays the same. The USDA doesn't change supply, or we're wrong and no supply was lost, but there is a demand loss. So let's say there is demand loss, and here, this is the USDA currently as of the June WASDE. This is their yield of about 44. This is how many acres. You're having a production of 3.4, 3.5 billion, and the crush is the same, but we reduced the exports here to 1150. And if you only change the demand, we've got carryouts of 500 bushels, which is so high we're talking $7, $8, $9 beans, which again seems unrealistic because we are losing on the supply side right now too. And we're most likely going to lose some demand from South America and China. So when you combine the two together and we look at what the full picture is, what we expect between the lost acres and the lost demand, here are our lost acres, around 75 and 74. Here's our yield, coming back down to 72, back to 42. And we're rounding. Every time we do these calculations, I'm either ending up in the low 300s or the high 280s for ending stocks. If that's the case, we're probably right around $10 to 11, maybe right around harvest, probably $10 for soybeans. Now, if demand picks up, we're heading on, and China doesn't have a slack off and we don't lose exports to South America, then we're, heading back over the 13 and 14s again. If soybeans recover and we don't lose acres or the yield is much higher, we're going to probably go lower. But right now, this is where we're looking for, and this is how we're positioning ourselves going forward. And with that, I'm going to switch this over to Drew.
All right, thanks for that, Craig. So as we discussed throughout the presentation, we're going to go over just the broad brushstrokes with a conclusion here. So 2012, 2013 ending stocks are tight, but they're going to be replenished. U.S. supply, South American supply will do a good job of replenishing stocks that are currently tight. We're likely going to have a loss of yield in some acres. We're going to be close to the 75 million acres as opposed to the 77 that the USDA originally thought. Of course, this is due to the late harvest of the soft red winter wheat and then also some prevent plant. Global supply is also on the rise, as Craig went over. South America is producing more crop than they ever have. We're also, weather being the outlier, looking to have a good crop here as well. South American long export tail will extend into the U.S. marketing year. So that will take away from some of our normal customers due to the fact that their export tail is going to move into ours and take away some of our demand. China's slowing down. Demand there is overstated. And also, we believe that the USDA is overstating supply and demand. So what does this mean? How can you put this into action? Well, with that said, we've got to go through some typical things. Craig and I are both registered, so we can't give direct trading recommendations via webinar, but we do have some ideas. So with that said, let's go through this quick disclosure here. Because we are registered and this is a webinar, the NFA has regulations discouraging us from sharing specific trade recommendations with you during this event. However, we do have very specific strategies for both hedgers and speculators based on what we have discussed today. We encourage you to contact us to learn these exact strategies we'd employ based on your circumstances as a trader or producer. And once again, before you enter any trade, you should know and understand the risks of trading futures, options, and spreads. With that said, here's some of our price outlooks. With the weather rally potential, we think that November beans could get up to 13 bucks. We almost got there today. We got to $12.95, and then they sold off before they ended up settling around $12.84 3/4. We also believe that old crop will support new crop. Old crop, as we discussed in the very beginning of the presentation, supply is extremely tight right now, so that should help support new crop. There's not a significant weather damage to this crop, we think that November beans are going to $10. We also think that the November 14, November 13 can go from an inverse to a carry. Today we closed at around a 38.5-cent inverse. So we think that has the potential to go all the way from an inverse to a carry. For protection, we think around $12 is the level for that. We think there's a $14 ceiling and a $10 floor for November soybeans. So those are some of the price levels we're taking a look at. Like I said, if you want to know exactly what we're doing to try and take advantage of these thoughts and ideas, just give us a call. We'll be more than happy to talk to you and explain them. Just can't give them out over a webinar due to regulations. So with that said, let's take a look at some of the offers that discuss the exact trading ideas we were going over. We've got Grain Analyst, which is put out by Andy Daniels. It's his grain commentary and trading recommendations. His name's on the door here. He's been trading himself for around 30 years, so he trades his own money in the markets every day. So he gives you his insight, his trade recommendations. He's got a daily report. That's actually complimentary for Daniels Ag Services clients. If you're not a client, though, it's 99 bucks a month, so it's something to consider if it's something you'd like to receive. You've also got Turner's Take, which is Craig Turner's futures spread trading commentary and recommendations. It covers the grains, energies, and I believe he touches on some livestock in there. It's a great newsletter. And then also the Wilkins Ag Wire, which is my daily grain marketing video update. Those are both Turner's Take and the Wilkins Ag Wire are complimentary. You can get those for free and sign up for them. Grain Analyst, either have to be a client or it's 99 bucks a month. So with that said, let's jump into a little Q&A here. I see we do have some few questions here. Craig, you want to read the first one off there?
Sure. I see one. You got one from Alex here. He's asking about free trials and future spread trading. If you can take a look at Turner's Take. That's my newsletter, and you certainly can trial that for free. It's right on our website, and you'll see an email after the webinar about that. There is as far as Grain Analyst goes concerned, there is a free subscription, for Grain Analyst. There's a premium subset and then a free one. The free one is market commentary, and that's on Fridays. And there's also blog posts, and we'll sometimes send out special reports to them. But the actual trading, Andy pretty holds close to his vest, so you got to be a subscriber to that. But if you are interested in future spreads and charts and examples of what we're doing, I would look at Turner's Take. And Drew, we got another question here about what do you think about the current weather market? Do you want to take that?
Yeah, definitely. As Craig mentioned, we've added around 50 to 60 cents in November beans here lately. That's due to some short covering, and then also we've had some forecasts that have come out and said that a fourth of the Corn Belt and even into the plains are going to experience hotter than expected and drier than expected forecasts. So we've really added a premium here into the market as of late. Now, is that justified? Personally, I don't think so, due to the fact that, yes, 1/4 of the Midwest is expected to have that, and this is expected, this hasn't happened, but the other 3/4 of the Corn Belt is also expected to have nice growing conditions, and weather has been really good so far for most of these areas. So we believe, and I believe, that the fourth of the areas that are going to be drier and not as much rain as normal, that the other 3/4 will more than make up for that. So, I mean, we took that into account when we came up with the 42 bushels per acre, the 75 and some change for harvested acres. So we took that into account, and Craig put those models together that really did a good job of explaining things and putting into a graph form. So, long story short, the fourth could be an issue, but the other 3/4 that are having nice growing conditions should more than make up for that. So great question, though.
All righty, we got another question here. With beans, in your view, headed lower, what, if anything, does this mean for bean oil? I can take this one, Drew. Bean oil, if soybeans start to head lower, it's going to drag. I think it will be a drag on bean oil. I think that the meal component will go down much faster than the oil. So if you're looking at the relative values of meal and oil, meal will do bean oil will hold up better to meal. But if beans are going to be coming down, and if they do go down to 10, like we think, by the end of harvest, I would think bean oil. I have a hard time seeing how bean oil would stay at these prices, even though I think in December is trading about 46.13. if you lose $2 or $3 in beans, oil's got to come down with it. I just think it'll hold up better than the meal. And we have another question here from Matt. Seasonally grains go up in July. You see $14 as a top in soybeans, and that's all going to depend on the weather, really. I mean, if you look at some charts last year of what a weather market looked like, I think last year's charts of corn and soybeans are the perfect examples of what a real weather market can look like, where the weather market turns into real serious loss in yield and acres. So what's going to be the top? Who knows? That's what the next 6 weeks are for, because they got to get through. Basically, they got to emerge. They have to grow, and then we got to get pollination has to occur, and then really the crop will be made. But that's not going to happen until August. So it's all going to depend upon the weather. If the weather is great, we may not even break 13. If the ridge that we're seeing keeps on building, and if it's the problem last year, the ridge that happened weather-wise stayed around for like a month, and usually ridges, the way the weather patterns go, they might be around for a few days, keeping the weather hot and the moisture out, and then they move away. And that's what this ridge is looking at right now. And if that's the case, then there's not going to be a whole lot of damage. But if we get a situation like last summer where the ridge stays there for 2, 3, 4 weeks, then all bets are off. So again, that's the nature of the weather markets, though. Other than that, though, we don't have any other questions. Do you see any, Drew?
No, I think that that pretty much does it as far as the questions go. So good questions, and thanks for being interactive, guys.
Okay, well, that concludes the webinar. If you have any other questions, let us know. Otherwise, we are going to run through our last risk disclosures per our compliance officer. And if you have any questions about us, Daniels Ag Services. Also, this webinar is going to be archived, and we're recording it right now. It should be available later today or first thing in the morning, and we'll send that out. If anyone wants to see our slides or those tables again, they'll be posted too, and you can take a look there. And here's our second risk disclosure, and feel free to contact us if you have any questions. Thanks for coming today, everyone.